there continues to be a lot of capital that's available to invest by private equity funds. This is a chart that we show every year. We update it every year. On the chart on the left is showing deal activity in the red line and deal value. So that has been a bit choppy. Some of it is because of high interest rates. When interest rates are high, there's not enough, the ability to raise debt to finance a lot of deal struggles. So that has been a little bit choppy. But if you look at the chart on the right, there continues to be a lot of capital. What is interesting is that fundraising continues at a strong clip. In comparison, if you look at the volume of dry powder, that's probably not increased as much. But bottom line, for good deals, there continues to be a lot of capital that's available. If we zoom into deals in materials and resources, I think there we continue to see a challenging environment that has been declining for the last few years. A lot of this driven by the broader challenges in the chemical and materials industry. In terms of if we go further down and look specifically in plastics M&A, we actually see a little bit of growth, and we saw quite a bit of deals that were completed last year. This is a space that continues to attract a lot of private equity capital. We do a lot of work in plastics and polymers, and we see that multiple factors are driving this. There's more PE interest in this space. We are seeing a lot of divestitures in this space. Financing costs have led to more smaller transactions, and that's also a reason why we see this pick up. But overall, we see growth in this space. In terms of valuations, there were a few big deals that we saw last year. Some of them are on the chart on the left. Overall, private equity continues to pay a little bit more than what valuations in public markets are, but overall, lots of interest in and around specialty chemicals. So with that, let's talk to these guys. We've known both of these guys well for a long period of time. But what I wanted to do was brag a little bit about how awesome our speaker curation has been, because we kicked off Oil and Gas Day with Brad Childers as our keynote speaker, who bought Tops, which was a portfolio company of Tom Ambrose's company. So that's how we kind of tie the loop there. So just kidding. It's too late in the day for these kinds of jokes. But anyways, Tom, tell us a little bit about your company. We've had another portfolio company of yours, SCS Technologies. Cody was on a panel as well. So, but tell us a little bit about Black Bay.
Sure, and I apologize if everybody's actually here till 5 o'clock listening to frickin' frack. But so we're a private equity firm. We're based in New Orleans, and we really invest across the energy and chemicals complex. So upstream, midstream, downstream, water treatment, electrification. It's a pretty broad mandate. We have about $500 million under management. We typically invest 30-ish million. And we're nowhere near as interesting as ExxonMobil scouting exercise, but we have a pretty broad set of parameters. So it's really more like, are you doing something better, faster, cheaper, safer, more sustainable? Doesn't have to be all of those, but it's got to be something. I have a calling card, because most of what we invest in are smaller companies. They might be 3, 4, 5 million of revenue. There might be 100 million of revenue, but it's kind of inevitable. You're a smaller player, you're doing something niche, and so you got to be really good, and you got to have a reason to exist. And that's really what we focus on. Most of the time we're control investors. We will do minority investments. We've been pretty successful. We started in 2016. It took us 2 years to raise $1, but ultimately we raised our first fund. We raised a second fund in 2022. And we've done pretty well. And a big theme for us has been, big themes for us have been around electrification. So electrification of the overall energy industrial landscape. We've done a lot around chemicals that play in energy plus. So a lot of things where the energy end market is really important, but they've got optionality in other markets. And then actually sulfur has been a big area for us. So sulfur treatment, H2S, CO2 treatment, mercaptans, all sorts of things, gas impurities, liquids impurities, and that can be upstream, midstream, or downstream. So those are some of the things we've played in.
Can you maybe talk a little bit about some of the chemicals focused investments that?
Yeah, sure. So we had, I'll get specific. So we've made 4 chemical investments out of 14 portfolio companies and 2 funds. First one was an H2S scavenger. Triazine is the incumbent treatment methodology from a chemical perspective in upstream markets. We invested in NextGen, which had a unique non-triazine scavenger. And we'll talk about this later. There are a lot of non-triazine scavengers. It had to be less expensive. That was really what we find especially in the upstream market, because it's kind of pervasive across the energy complex. You can have a better technology. It can be more sustainable. It has to be less expensive to get any market share. And so these guys came out with a scavenger that was less expensive, better kinetics, and ultimately did really well. We third-party manufactured everything, and a manufacturer bought it. So that was an interesting exit. We sold it to a portfolio company of SK. We have Clean Chemistry, which is a water treatment technology, which is a good example of the kind of energy plus idea. So they have microbial biocide technology. It's a heavily patented chemistry with an automated unit. And we started by treating oil-filled water. So oil-filled water is you're recycling more and more, a lot more bacteria in the water, much harder to treat. That's fairly analogous to other industrial markets. So we've moved into food and beverage. So you think about a closed loop facility and a poultry processing plant, pulp and paper facilities, industrial water treatment. So they've moved into those markets. And then we have Merichem Technologies, which is a sulfur treatment platform that's not as upstream focused as kind of everything else. So H2S is ubiquitous across upstream, midstream, downstream. It's in biogas, RNG, landfills, chemical plants. It's all over the place. And they have technologies that treat both in liquid and gas kind of around the world in all those capacities. So again, it's particularly in the chemical space for us, things where there's a really strong use case in existing business and energy. Where we can help is we show up with capital, we can help with relationships, we can help with introductions, build out team, acquisition to move into other markets. And then from an M&A perspective, that's when they get interested. You know, unfortunately, something that's predominantly upstream focused right now, investment bankers stop calling you back because they only like to do what's easy. And so once you've got a more diverse business, you're in some other end markets, the buyer universe is bigger. And so that's a really key kind of focus for us.
Thanks, Tom.
He's better though. He's really not that bad.
We'll call you back. We'll call you back.
Yeah,
Guys.
just won't pay for lunch.
Yeah, we still want to do some of the upstream stuff.
Yeah.
But yeah, I'll call you back.
Chris, tell us a little bit about KeyBanc and your investment banking practice.
No, happy to. It's funny staring at myself here on the screen. If you want to know what 2 decades of investment banking does to somebody.
Yeah. If you want to know what AI does, look at my picture.
It's a much younger version. So yeah, in any case, I'm
neither of you is paying us. Charles Sherrington paid us to advance 1 page, so we're going to stay here.
Yeah, no, it's good.
Yeah, that's why we're last.
much younger version. So I'm a managing director in the M&A group at KeyBanc Capital Markets. A little bit about KeyBanc Capital Markets. We are the investment bank within a large U.S. bank called KeyCorp. Our roots date back, a couple hundred years at this point. We're based in the Midwest in Cleveland. I'm actually from the Cleveland area. And obviously being, from that area, industrials is a big focus area for us. So a lot of chemicals, materials, businesses over the course of KeyCorp's heritage and within the investment bank, a lot of what we work on, has a industrials, tint to it. And within that, one area that's also very busy and active has been our chemicals and materials practice. And it's interesting, you talk about chemicals, it's almost not really an industry, it's a lot of sub-industries, right? Because it's just so broad. And so we've done stuff, Tom was just mentioning the oil field, we've done stuff within the energy side of the value chain of chemicals and materials. So think production chemicals. We sold a business some years ago called Flowchem that was in the midstream pipeline space, specialty polymer that would help with flows through midstream pipelines, Houston-based business, where we first got to interact actually with ADI, did a great job on that. We've worked around compounding and plastics, and I know we've had multiple speakers up here, today who touch on that space. We've done stuff in water treatment. We've done stuff in reactive chemistries, intermediate chemistries, reagents, things going into pharma, and all sorts of interesting markets. So it's a really broad practice. One commonality is we do tend to focus a bit more on stuff that has a specialty element, meaning some degree of formulation or technology where you're interacting with customers or you're interacting with the value chain to try and drive a solution for a customer. So that'd be some of the linkage across, those deals. But it's been, it's been a great run for me. My entire career has been here with Key, just coming up on 2 decades. So very much my first session today. So thank you very much for the invitation. I've enjoyed, listening to everybody. And sorry to be at the very end here between you and going home.
So Chris, this point, right, that chemicals is really a bunch of industries or segments, right? In fact, what really surprises me at that is that a lot of people, a lot of investment banks, a lot of private equity firms will call chemicals actually industrials. Or when you go to a private equity or an investment bank's website and you look for transactions in chemical space, you won't find any, because the filter will be like industrials, and then you have to go there and look at this and say, oh, okay, these are all actually chemical companies. Does that say something about the appetite of investors in and around chemicals and materials?
Let me answer it this way. A little bit of the evolution, I think, of the space and what I've seen doing this now for a couple of decades. When I first started, the chemicals sector as an investment area of interest was very much a backwater. So I'd say you had a couple of PE firms that have been doing it historically, the likes of an Arsenal Capital Partners or an SK, right? But it was a fairly limited, you kind of counted on one hand, these are the guys that really know the chemical space. And a lot of those firms had started on the backs of operators that knew specific areas of the chemicals world and had left and become or flipped onto the investing side. And over time, fast forward 10, 15 years, you did see it really broaden out. And I think there's a few attributes and reasons for that around chemicals that are unique. The cash flow profile for a lot of these businesses is very attractive. Mm-hmm. Again, putting aside the heavy asset manufacturing, right? There's a lot of specialty chem businesses that have very attractive margins, asset light profiles. There's all sorts of twists on it. You can do, asset light manufacturing. You can do distribution. That's been a big area of growth and a way for
sticky revenues.
Yeah, people to dip their toe into chemicals without, getting into something that's too, you're drawing formulas on a piece of paper to understand what you're looking at. And so the interest around it continually broadened, I would say, over the last 10, 15 years. And it's been a very sort of virtuous circle where people have done well on chemicals investments. More operators have come out of industry to become investors and work alongside these private equity firms. More and more firms have built out specialties around chemicals. And so today it's a very active, part of the M&A market. And, folks like, Tom and crew have done such a great job in that space too. And it's like everything in investing. As long as people are making money in it, there's money following it, and as long as that continues to be the case, I think you'll see a lot of interest remain around it. So.
Yeah. So I don't think we met when Flowchem was sold, but we actually had supported Arsenal when they bought Flowchem, and and nobody had heard. And I remember the first call that we got from Arsenal, it was a very generic call, like what have you done in downstream oil and gas markets, and then. So I sent a response back saying these are the things, and that I mentioned drag reducing agents, and immediately I got a call back and we started supporting them. And then we did, and then Flowchem was sold when you guys sold, and then suddenly, like every specialty chemical company out there with some exposure was suddenly making drag reducing agents, right? So there's a lot of opacity in a lot of these specialty chemical markets out there. So Tom, you guys have built a nice differentiated position in and around the sulfur value chain. Starting all the way from Pinion Midstream, which kind of does high H2S processed high H2S streams, if you will, in through midstream, through Medichem and all of that. How did you guys get there? Was it happenstance? Was it you make an investment and you learn about it, or did you guys have a proprietary thesis? How did that come about?
Yeah, it's interesting. I think when you're a specialty private equity firm and we're focused on energy and chemicals, you kind of have to carve out some niches for sure, because to Chris's point, I mean, the chemical market is enormous and you just can't learn it all. You can't even pretend to learn it all. And so back in 2016, a big part of our process is we go spend time with facility engineers and midstream engineers and drilling completion guys and just try to understand what their pain points are. So we're not spending time with the C-suite. You're talking with the people who actually run these assets, run these facilities every day. And what's Halliburton or Clariant or whoever not delivering for you? And we're hearing over and over and over again the issues associated with H2S scavengers. And assets were getting more sour. The upstream guys were having trouble with it. The midstream guys were having trouble with all the H2S that was coming at them. And it was both on the gas and the oil side. And we got introduced to a technology that, it's a very long story that I'll short circuit, that ultimately became next gen. And so we built some expertise around that. And we built, to Chris's point about operators, we built a network of people who are way smarter than we are, who have built and operated these businesses and dealt with these problems. And then one of our strategic advisory board members came to us with the idea for Pinion, because they were a producer in Southeast New Mexico. It was a guy named Floyd Hammond, who was one of the guys who ran Ameridev. And he said, I know you guys are really into H2S, into investing in treating H2S. We don't like H2S. That'd be kind of weird. But he said, I've got this great asset. There's too much H2S or CO2. We got to figure out what to do with it. And so through our next gen guys, they went and treated a bunch of the gas and the oil in the area. They confirmed, they said, you need a midstream solution. And so we then, in concert with the producer, built a midstream solution. And from there, we saw at the midstream level, sure, Pinion was a great answer for a small area because it was very capital intensive and you can tie into it. But the same issue was getting worse everywhere else. And so then we saw American. Mm-hmm. And along the way, we had seen that H2S is a problem in biogas facilities and landfill facilities and refineries and everywhere else. And so I think that's a way that you can build a real expertise as an investment firm, is you do more things in the same area. And if you can find a good niche, you can do a lot in it. We've done the same thing with electrification. You mentioned TOPS. We were the first investor in TOPS, which was electrifying gas compression. And so they were pulling the guts off of a traditional gas compressor, replacing it with an electric motor. Electric motors are more reliable, they can be instrumented. And then from there, we invested in AID, which is a VFD manufacturer. And so that's the way we do a lot of our things, is you kind of make that first investment, you build the expertise, and then you can keep going.
Yeah, thanks. That's helpful. Chris, so talking about specifically investing in and around chemicals, materials, I guess what are some trends that you're seeing?
It's interesting. Your charts, I think, are spot on. I would say activity over the last few years has been more muted. I mean, it's been a really dynamic, call it last 4 or 5 years, right? You go backwards in time and you start with COVID and 2020 time period, all sorts of disruptions to supply chain and, pricing and all of that. And that takes, kind of a couple of years to work through. You've got dynamics in 2022. We had a few things in market. In the back half of 2022, the banking, market became very, very, tight and constrained. You had election uncertainty. There's just been a lot going on. I think there is a real desire for folks to transact, to do deals. I think part of the challenge that you've seen candidly over the last 12, 18 months, the performance of a lot of businesses in the chemicals and materials space, it hasn't been dramatically negative, but it hasn't been overly positive. Yeah. You've had kind of little left to right, mostly trending in a lot of those subsectors I mentioned earlier. And for our business, folks want to have a level of certainty if they're going out to market and trying to transact. And same thing from a investor standpoint and buyer standpoint, and Tom lives this every day, we've felt that the investment committee bar has been pretty high the last few years, where there was maybe more of a reason to find to not do something or not like something versus a reason to say, hey, I'm going to get this done. And I do think that's starting to change. It's funny. I mean, in our industry, people joke about it. We've been saying consistently for 2 years that we're 6 months away from like the deal bonanza coming back, right? Like 2021 was this high water mark. Couldn't find an advisor because everyone was so booked up, and it was just an insane period. And you saw that in the charts we put up, right? And that obviously has trended down a bit. And it's always been this mantra of, okay, we're going to get back to just the floodgates reopen once we get through the election and there's some certainty. And I do think at the back half of this year, not to re-echo the same record, like
6 months from now.
6 months from now, we should start to hopefully, pick up. But maybe that's the eternal optimist. But it's been quieter than I think folks would like. And like I said, it can't go on forever. I mean, I think people do have to put money to work. LPs are pushing on the PE guys to return money, so you need to have exits. There's a lot of reasons to be optimistic that this year does start to pick up. I don't think it's going to ever, this year go gangbusters, where again it's just this bonanza like it was, back in 21. But I do think you're going to see more activity as we get deeper into the year.
Yeah, I think your earlier question though it's a good point on people classified as industrials or whatever they say. Is a lot of these firms have gotten bigger. They've had success. They've gotten bigger, they raise bigger pools of capital. It's important to remember those pools of capital sometimes don't want to see things that say energy or say the word chemicals. So as they raise capital from bigger endowments or pensions, things like that, sometimes there's some restrictions around what they can do. And so you may go from being a chemicals fund to a materials fund.
Yeah.
And so it's not, we don't have energy in our name anymore, right? So it's not that we won't do it anymore, but there's some people who they delete your email when they see something like that. And it's reality. And so you got to think about where you're sourcing your capital from and how you have to message things.
Is that changing, Chris?
No, I mean, I would agree. I mean, and the bankers probably lead the way on some of this too, because when we go out, we want as many people to look at something as possible, right? So, it's funny. It's like everything, right? Things go around, and sometimes you end up back where you mentioned Flowcom. It transacted like 5 times, and now it's back to being PE owned again, right? And so you see an evolution, around a lot of this stuff. I do think the dynamic of specialty materials that are enabling things like electrification that Tom mentioned, or enabling a lot of the mega trends that we talked about earlier today, decarbonization, all that is very, very positive. And where you do run into issues is more the stuff that is maybe more the bulk chemistry, traditional, right? That there is probably less of a LP, and a lot of it's LP driven, depends on where your LP base is. LP bases in Europe.
Yeah, that's what I was going to ask Tom, actually. I mean, you probably know better at this, right? I mean, your LPs are probably comfortable in investing in oil and gas, but there are probably a lot of LPs who, for various reasons, right, are not comfortable.
Totally. There's a lot of people who will never invest in one of our funds. But to your question on is it changing? I'd say versus 2 to 3 years ago, the pendulum is swinging back.
Yeah,
it's not all the way back by any stretch of the imagination, but the endowments and some other groups that have a lot more flexibility around their capital, they're starting to inch back in and learn more. Family offices have gotten much more active.
Yeah.
So I think there's a lot more of a you see it in the public markets too. I mean, Exxon, Chevron, Conoco, most of these guys are at all-time highs in terms of market caps. And so I think there's fewer people investing than there were 10 years ago, but it's a lot better than it was 3 or 4 years ago.
Yeah. So we did a piece of work for a corporate development team of a very large chemical company that wanted to divest one of their divisions. But this is a very large division, right? Multi-billion dollars in revenues. And so we went and interviewed a bunch of investment banks, a bunch of private equity investors, and we heard this sentiment, right? To the point that for them, the buyer universe was restricted essentially to a bunch of sovereign funds out of the Middle East or, out of Asia that would consider. So there is a real, filter there in terms of. So. Given that deal activity has been muted, what have valuations been looking like, Chris? What are you seeing?
We're going to have different answers.
No, I mean, look, I would say it's certainly come in. We segment the world a bit, right? If you've got a asset, right? A really nice specialty business. Maybe there's a services component mixed in there for, a little extra excitement around the asset. Those things still are fetching, very, very attractive prices. I will say it's down from, if you look at the peak.
So even if the revenue has been, or EBITDA has been flat, they are still,
Well, no, that gets into category 2.
Okay,
So
okay. Sorry.
Yeah, category 1 is like, it's been growing, it's high margin. A lot of people are going to be interested in it. Those are still trading, not quite at 2021 peak multiples, but maybe have come in a turn, right?
So can you throw out a number or a range?
I don't know. If you had something that would trade in the, call it, mid-teens before, it might be low teens, right? As a super specialty business, right? Contrast that with something that's maybe more of a B asset. To your example, it's either been kind of flat, or in some cases worse, it's been up and then down and then up. And those candidly have been harder to get done. So if you can get it done, that is definitely trading in, multiple turns from where it would have been if it was, 2021 and back in kind of the peak market. So we've definitely seen a bifurcation in the market between really, really good assets where you're going to get a lot of bids, a lot of activity chasing it, and other stuff where it's going to be a little bit tougher to get done. And the stuff that's gotten punished the most, not surprisingly, is the stuff that's in the latter category.
Yeah, and I'd say there's the bifurcation between the high growth versus the flat business, but then there's like subsector bifurcation too. So like water treatment, out of control. I mean, we joke that we should rename every one of our companies with water treatment in it.
Well, what's driving that? The PFAS and all that?
I think it's all, I mean, you would probably have better perspective on the kind of broader answer here, but PFAS, and everyone's talking about everyone wants cleaner water. There's more demands on water. It's harder to find. You need to reuse it more. I think it's kind of ubiquitous across industries and across geography. And so people believe that it's a very consistent growing trend. And if you look over 20 years, it grows every year like clockwork. I think a lot of times people kind of miss the forest for the trees to some extent there. But if you've got something that's got some level of technology, a diverse client base, diverse industries, and you're in water treatment, like it's probably going for a pretty good number.
Yeah, I mean, water, for all those reasons raised, and the LP community loves it because it's an easy story. It's helping humanity, and everybody needs water, and so it lines up well.
So then you can contrast that with something that's pure play upstream, a production chemical business. Unless there's like a real reason for someone to own it and really capture a lot of value from it. Like with NextGen, the manufacturers could recapture the entire margin. So there was some competition there. But if you've got a production chemical company, it can be an awesome business, be growing like a weed, taking market share. I think the average investor or even the educated investor worries about the overall market growth opportunity. And so valuations are muted because of that. It all comes back to growth. And it's not just specific to the company, it's the end market that they're playing in. Like, is that market growing? Because you're in a higher interest rate environment. So without the growth, it's hard to match valuations when money was basically free.
Yeah. So Chris, if you had President Trump's here and you could change whatever you wanted to change, what would you change? Interest rates? You'd change inflation?
Yeah, not getting into any politics.
Nothing like asking the
exactly.
If you had gods here, let's go.
No, I think the biggest thing that's driving uncertainty right now, and that is another impediment that our business hates, it's just uncertainty. Regardless of the political sphere, if you know what you're dealing with, then you can plan around it, model for it, account for it in value, all those things. And certainly I think right now there's a lot of just uncertainty around the tariff side. Right. So as we talk to our clients and folks, because I do stuff within chemicals and materials and then industrials more broadly, I think everyone's just trying to figure out that side of the,
So maybe I should take a step back, right? I mean, I actually wasn't thinking of tariffs, right? I mean, obviously there's a lot of uncertainty, but like, let's set tariffs aside, right? Like if you were to, one of the things that I read is that debt's been harder to raise because of higher interest rates to finance a lot of these deals. Is that still true?
I would say, honestly, the debt side, certainly for a good business, there's a lot of debt money out there. I mean, massive amounts, because what you went through with...
But is it available at rates that private equity...
It's a lot more pricey, but I think it's...
I'd say the high yield market, the private credit market, if you can touch that, you're a $25 million EBITDA business or north. It's probably fairly readily available. It's tough if you're 3, 4, 7 million of EBITDA, you don't have a long track record,
so
a little bit of
smaller
capital
business,
intensity. It's tougher than it was for sure.
Sorry, go ahead.
No, I was going to say, it is a lot more expensive. But what you've seen in the market is the whole private credit side of the market is massive today, whereas 3, 4, 5 years ago wasn't as big. And so you've got the bank market, you've got the private credit markets. Like, there is money chasing deals, but it is a lot more expensive today. I mean, you think about a business back when, to Tom's point, money was free, you're paying 2-3%. Today it's like 9-10%, right? And that is money that can't go to other things,
exactly,
right, to fund growth initiatives, and certainly in a leveraged situation, right, where if you have a traditional PE deal, and a good chunk of that is debt, like, they're very smart about making sure that the capital structure is going to work, but there is a cost, and some of that is, at the expense of growth initiatives or other things that you might have been able to do more easily when money was free.
So what would it take for us to accelerate this 6 month out? Is there like a couple of dominoes that need to fall for deal volume to pick up, for a number of transactions to pick up?
My view, and I'm curious to hear Tom's input, would just be folks having a good Q1, right, and putting that into the TTM numbers. I think a lot of people they're right on the cusp, or to my analogy earlier, it's been kind of nothing dramatically down. It's just been a little drifting left to right. If that left to right can start to just slope up a bit. I think that gives a lot of sellers the confidence to, they're not going to get the value that, from a multiple perspective was maybe there, at the peak, but it'll be transactable, right? I think that's everyone's biggest fear, at least our clients, is we don't want to go out and have a foot fault where all of a sudden the performance starts to trend down and we're out in market. And so you've seen alternative types of processes. This has been the story of the last few years: quieter processes, discussions, the stuff that's really fireside chats. The stuff that's really broadly out there is stuff that water treatment, right? It's going to be fine. Just keep going up to the right. So that's what I would say. My view is just continued solid performance of the underlying businesses. That'll help more than anything.
Tom, you have would you add something else that would change?
How do you make M&A great again? I think it's all valuation expectations, which good investment bankers like Chris and his team do a good job there. But a lot of times you're dealing with, it's a guy who sold a 7-Eleven one day and then he's representing a company. A lot of times they have very unrealistic expectations on value, and that can be really challenging, particularly in a market like this where debt is more expensive, capital may not be as easy to get your hands on. It can really cause a freeze on things like that. So I think more education from the investment bankers of the world, and like we're more inclined to invest or buy a business that has an advisor than doesn't, because it just takes a long time to get all the information together and pull it all together and manage the process and all that. So we're probably more inclined to do that today than we were 5 years ago.
So let's say that this happens, you get to the 6 month point and this actually happens, right? What does the supply curve look like? Is it a lot of divestitures by large companies? Is it a lot of independent businesses getting sold? What does that look like?
I think it's independent businesses. I think hopefully it's a lot of PE activity too. There's a lot of
there's a lot of companies that are locked up in PE portfolios.
There's a lot of companies that have been sitting in PE portfolios for a while. The impetus is there the push from LPs is there to get capital back, right, and to have exits. And what we saw at the beginning was more driven by funds that really needed to maybe raise a next fund, that was driving the M&A activity where they couldn't wait, right? But if you're a PE fund, you got a great track record and you're on your 8th fund, you've got a little more wiggle room with your LPs over the last few years to say, I hear you, but they're kind of withstanding the heat. But I feel like the heat's been ratcheting. I mean, I'm curious to hear, Tom's perspective. I think there is a lot of M&A activity that will hopefully come out of the PE community.
I think the other thing that's going on, and I'm sure some of the folks in the room have heard of continuation funds, fund continuation vehicles, that's actually put a damper on M&A activity because it is a new source of capital. So these private equity funds sit there and they've got 1, 2, 5, 7 investments. They can actually sell that to a new financial sponsor. It's not a new financial sponsor, it's a new entity basically with LP capital. And so it's an exit for the legacy investors, but it's really not M&A activity whatsoever. So the sponsor stays invested, they roll their piece. To some extent, it's kind of a conflict of interest, but nobody says that.
Yeah, so I wonder, like, what do those transactions look like in terms of valuations?
So the thought process is it's kind of a market check because you're going out to a sophisticated buyer universe, a la the investment community, and they should know how to value it. I think in reality, and some private equity lobbyists are going to shoot me for saying this, but the reality is when you're going to the LP community to go raise more capital, they're looking to the sponsor on how to value something.
Yeah.
And so we've never done a continuation vehicle, but plenty of people do. And so they look at the sponsor and say, well, how do you think this should be valued? And that LP, they're not used to doing deal by deal, direct deal investments. So they kind of like, okay, if you go to market in an M&A process, you have a true market check. Like strategics, financial buyers who are looking at the asset directly, that's your market check. Fund continuation vehicles, you don't really get that. You get to some extent.
But a lot of that's now happening.
A lot of it's happening, and I think a lot of it gets priced off the mark that the private equity firm carries it at. And so there's a whole interesting dynamic where like it's a discount to a mark, right? And it's nice because it does
talk about that.
Preserve, any dynamics where people in private equity don't want to like have to reassess every month, right? Like, hey, exactly how is this, sort of sitting on my books? And so it is an elegant solution. It's sophisticated folks and it's worked, I think, well. And some people also use it, to be fair, to park trophy assets in too, where they take the very best in their portfolio and say, you know what, I've got a proven winner here. I could sell it and make a really nice return, but then I got to go redeploy, capital, and what's a better sort of known winner than what I already know the best. And so it's not only, a way to kind of kick the can. Some of the assets that go into there also are really, really nice businesses that people just don't want to.
Yeah, I mean, Lime Rock did Crown Rock, right? It was probably the best private equity deal of all time.
Sorry, I missed that.
Lime Rock did it with Crown Rock. It was a continuation fund. They rolled it from their prior fund, and it was a massive home run when it ultimately sold to Oxy. And so that was a very good example of you cherry pick a really good asset, you roll, you keep rolling, and they probably had another 10 years of life on that investment.
Oh, this is the Crown Rock acquisition by Oxy. Sorry.
Phenomenal outcome for legacy investors who rolled and then ultimately the new investors who came into it. So for everybody who knocks the idea, it can work really well.
Yeah.
And it can be very rewarding for the LP community.
So Tom, if you look at the data, right, there's a lot of capital available. Is that true? Is there a lot of capital available? Is it easy to raise funds? I use the word easy lightly there. It's never easy to raise a fund. But
for some groups, to your point, like people are on Fund 8 and all that, and they've got fundraising machines, it can be easy for some, for sure. I think it's easier for us to raise capital today than we were raising Fund 1, or I hope it is. Doing the wrong thing if that's not the case. But I'd say the like dry powder, there's money everywhere thing is really nuanced.
Okay.
Again, I keep coming back to energy, like the traditional energy space. I don't think that's the case. You look at the E&P landscape, there were much bigger funds, and those have all, while the same names are still there, but the funds are a lot smaller. Midstream, same deal. In the broader diversified energy guys who invest in chemicals and midstream and a whole bunch of stuff, it's definitely down. And when we're in a process, we don't see as much competition. So when we go talk to LPs, we talk about our competitors. There used to be 15 names on the page. Now there's 3, something along those lines. That depends on how you define them. Family offices have been more active lately. So as public markets and every other asset class becomes so much more valuable, the families have become more sophisticated and they're more active in our universe for sure. So I'd say that capital is more available, but like traditional institutional capital, if it kind of touches energy, I'd argue it's actually harder than it was
Chris,
to access it.
Chris, when you look at strategics, corporate groups, how are their balance sheets for investment?
Yeah, generally in good shape.
Good shape.
Yeah, I mean, folks are trading well. Tom mentioned it in the public markets. We have seen, I think COVID really forced a lot of people to look at their portfolios in detail.
Yeah.
And we were talking about corporate carve-outs. We saw some divestiture activity coming out of that. I'd say people are a little more, focused in terms of where they'll invest as a strategic, today maybe than 4 or 5 years ago. Has to be a really good, fit. The desire to take on something that's maybe a little bit more adjacent or a flyer, or we'll figure it out as we go. Not that was ever just prevalent everywhere, but I'd say it's reined in. People as a strategic buyer, we've noticed really, have gotten sophisticated on understanding their own businesses, where they want to be. They may have exited some businesses over the last few years, and they've got a pretty specific area of focus from an M&A perspective. And so they're a little bit more targeted, but they can play very well in processes. I mean, they're set up great today from a capital perspective, and it just comes down in a lot of ways to more that strategic fit than anything else.
Yeah, and you had touched on carve-outs. I'm curious, Chris. It felt like in 21, 22, all these chemical companies who had any energy exposure were all trying to carve it out. And they had all paid 15 times or something 7 years ago or 12 years ago, and they were trying to carve it out. And I don't think that many got done necessarily. How do you see the big chems guys looking at their energy exposure and carve-outs today?
No, I mean, I think you're right. I think a lot of people did look to to do that, and there was some that traded. I mean, what you saw actually is interesting. I think there was an international contingent as a buyer community for a lot of those, and so you think to the points that were raised earlier, where certainly in the U.S. and folks with U.S. and maybe certainly a European LP basis, it's a tougher space to be investing in, but that's not true, necessarily everywhere. There's some groups over in Asia, for example, that were ultimately successful strategic buyers on those processes. There's been a few deals even recently. India, that market's been doing phenomenally well. I mean, you look at the stock market over there, and you can debate, is it overvalued or not? But you have mid-cap companies, $40-50 million in EBITDA, that would trade on the Indian Stock Exchange at a great price, and so their currency and ability to play in a U.S. process has really ramped up in recent years. And I think the point you raised also was a great one, that family offices, I think, have stepped in as a buyer category. So if a strategic's trying to get out of their energy exposure, family offices have the ability to hold a business forever, don't have to think about how do I exit it in 5-7 years, and can look at it as more a combination of, almost a dividend paying business plus growth, right? Equivalent to something in the public markets, right? One of these funds that's out there that tries to mix and match dividend consistency with some level of growth. Family offices we've seen step into the energy space as a real player because there is a need. Like I think the one thing the investment community agrees on is it's not going away anytime right soon. And if anything, it's only in some instances increasing. And so there's a long-term need for, you mentioned, production chemicals, for example. I mean, you think about the cost of drilling a well, right? $8-10 million, whatever it is now. You need those chemicals more than you ever did because it costs more, and you're putting more assets and infrastructure into that ground than you ever were before on a dollar basis. And so no one is looking at it and saying, hey, there's not a need for that. It's just more about the nuances of, am I the right owner? What is the right owner? What type of capital is the right capital?
Let me open this up for questions.
Right, let us out of here.
I have a quick question. How do you look at patient capital? Because some of the inbox emails I get that, people have been on PitchBook. They see some of my offerings, and they're mostly family offices, and their pitch is, we're patient capital. And you had just mentioned, that a family office can hold for a long time. So from your perspective, what is patient capital? 3-5 years?
I mean, to me, patient capital means they don't have to exit like a traditional family office. And there's different flavors. You have some evergreen private equity funds that kind of sit in the middle. But yeah, so as not to confuse everything, I would make it a very simple definition and just say family office money or money without a defined time period where they need to return that to investors. Like it's their own pool or the family's pool of capital.
And so private equity would be what, with the LPs that they have as investors, like a 5-year exit or something?
We're impatient capital.
Three. I was going to say, we don't want to start with my 20-year cycle because that would, but in terms of, so it's
I would say most tend to look at kind of 4 to 7 years as being, we want to be exiting. They have the flexibility in many instances to hold a bit longer. It's not, you don't want a gun to your head that at year 6, you're,
sure.
absolutely have to be out there. But I would say broad strokes, 4 to 7 years is probably on it.
Yeah, traditional private equity fund has a 10-year life. And so investment period usually 4 or 5 years where you can invest new capital into new platforms. And so then theoretically, you got 5 to 7 years to harvest. Most funds have the option to extend to the point, you never want to be like Bed Bath & Beyond liquidating on the street. And so you need that flexibility, but it's hard to go into something as a private equity firm saying, man, this is going to take 10 years. You just can't. It's really hard to underwrite to that. Some venture firms can do it. Like some of the more successful venture firms, especially over the last 5 years, have actually gotten more, I'd say they've gotten much looser with what they can do and the parameters that they have from their LPs. But family offices have much longer time frames. I think one consideration with family offices is if it's a single family office, there is the risk that that head of the family or whatever changes what they want to do. And so that can drive a change in investment strategy that you didn't expect.
So I can't let you guys get away without asking a question, as you know. I think a lot of us in this room have been in the chemical industry most of our careers, and we've, like you said, Chris, we've seen the advent of more and more private equity involved in the chemical industry. My view is there are still only certain private equity firms that really understand chemicals and should even be in chemicals, and there's a lot of PE firms that should stay away from chemicals because of the nuances of EH&S and the CapEx required and cyclicality and other things. And so I'd be curious your view about, do you think chemicals is kind of specialized for certain PEs, or is it just like any other industry?
Yeah, it's a great question. I would say, to me, the easiest way to judge it in some ways is to look at the quality of the operating partners that go along with that firm that are looking at chemicals. Because if it's a PE firm that just shows up and says, hey, I'm investing in chemicals now, and you ask, okay, well, who are the operating partners that really know this space? Because no offense to PE, it's the same as investment bankers. Right. There's not many folks in PE that worked in a chemical plant, right? Same thing in my world. Like I didn't work in a chemical plant. And so don't profess to know that space is intimately.
But you can always hire a consulting firm where there are.
You can always hire a consulting firm. Correct. Yeah. So you hire ADI and you make sure you get. Fantastic. So I always look at it in terms of you can see the folks that are really set up to do it well because they've been investing not just in finance professionals, but more importantly, they've been gathering the right operating partners to know a specific sector and a specific space. And I think those are the ones that will have success over time. And I will say too, we don't see too many folks that are just, because within chemicals, again, there's a range of things, right? Like if you take a specialty intermediates business, highly reactive chemistries, can be dangerous if you don't know what you're doing. Most PE firms, even the ones that kind of dabble in chem, may be like, that's too chemy, right, for me. And on the other end, chemical distribution, right? That's another hot area. Everybody loves distribution businesses. If you want to, sell to PE, relabel your business as a distribution business. But chemicals distribution is a gentle way to kind of dip your toe in. You're not going to likely be having a headline risk where you wake up one day and, have a plant with an issue or something like that. So I think the market's been fairly responsible in terms of where people try to, part of that's dictated by the fact you don't want to lose money, but that's how I always, I look at the operating partner bench and that gives you a good sense.
I agree 100%. It's your operating partners, your advisory board, folks you put on the board of those portfolio companies. And that's, honestly, that's a lot of our time is just finding more people who can help us. Because we're not going to be able to go figure it out. We're not going to run these facilities, and we need entrepreneurs, executives, people who really know what they're doing to help us. 100%.
Excellent. Thank you so much, Chris and Tom. Much appreciated.
Thank you.
Doing this. And I want to thank everybody who has stayed here through the end of the forum. Deeply grateful for the support. Thank you. And with that, let's give the speakers.